Microsoft invested $13 billion into OpenAI. Amazon put $8 billion into Anthropic. Nvidia put $2 billion into xAI. This sounds like the greatest technology investment in history. But here's the thing about Nvidia's $2 billion. That money went straight back to Nvidia. xAI used it to buy Nvidia chips. Nvidia invested in xAI so that xAI could pay Nvidia. And once you see that, you can't unsee it. Because the same structure is everywhere. Microsoft, Amazon, Alphabet. The money doesn't flow into AI. It flows in circles. This isn't investment. And the Austrian School of Economics, Mises, Hayek, Botter, has a precise name for what it actually is. Malinvestment. In the 1920s, Ludwig von Mises developed a theory known today as the Austrian business cycle. The core argument is simple and brutal. When central banks artificially push interest rates below market levels, capital flows into projects that would never have existed without that cheap money. That's malinvestment. Not because entrepreneurs are stupid, but because the price mechanism has been sabotaged. Interest rates send false signals, and entrepreneurs respond to signals. Hayek described this in terms of capital structure. Cheap money shifts the entire economy toward longer production processes, toward projects that promise returns far in the future but require enormous upfront investment. Abstract? Let me make it concrete. From 2009 to 2022, the Federal Reserve held interest rates at historic lows, effectively zero for years. 13 years of cheap money. 13 years of false price signals. What happened during that period? Silicon Valley exploded. Startups with zero revenue were valued at billions. And the three largest AI companies in the world were founded. OpenAI in 2015, Anthropic in 2021, xAI in 2023. Coincidence? Now the numbers. And they are sobering. OpenAI, $13 billion in revenue in 2025. Sounds impressive. But simultaneously, $14 billion in projected losses for 2026 alone. In the first half of 2025, the company generated $4.3 billion in revenue, while posting a net loss of $13.5 billion. Profitability? 2029 at the earliest, if everything goes to plan. Current valuation, $852 billion. That's a price-to-sales ratio of 65. xAI. For every dollar xAI earns, it loses $26. It burns $1 billion per month. Target, profitability by 2027. Anthropic has raised over $64 billion since founding. The majority of it consumed by compute costs. Current valuation, approaching $1 trillion. Together, these three companies have raised an estimated $320 billion. Their combined valuation, nearly $4 trillion. And behind them, the hyperscalers. Amazon, Google, Microsoft, Meta are planning nearly $700 billion in capital expenditures for 2026 alone. 75% of that is directly tied to AI infrastructure. That's more than triple their capital spending from 3 years ago. Now comes the critical part. This is where it gets interesting. And this is the part where Mises would have rolled his eyes. How is this boom actually being financed? Let's follow the money. Because that's exactly the problem. When you follow it, it doesn't go anywhere. It just goes in circles. Microsoft invests in OpenAI. But a large portion of that investment consists of Azure credits, compute capacity from Microsoft's own cloud infrastructure. That is not capital flowing into OpenAI. That is a supply agreement dressed up to look like an investment. OpenAI pays Microsoft back with those credits for services it could not afford without them in the first place. Amazon does the same with Anthropic. AWS credits as investment. Then there's xAI. Elon Musk's company structured a $20 billion special purpose vehicle, $7.5 billion equity, $12.5 billion debt. This SPV buys Nvidia GPUs and leases them back to xAI. Nvidia itself contributed $2 billion to the SPV, partially self-financing the purchase of its own hardware. Let's be precise about what this means. Nvidia invests in xAI so that xAI buys Nvidia chips, so that Nvidia reports higher revenue, so that Nvidia's stock price rises, so that the investment looks profitable. The money doesn't travel from point A to point B. It travels in a circle, from Nvidia to the SPV to xAI back to Nvidia's revenue line. Roland Bader, the Austrian school's sharpest German language voice, would have summarized this in one sentence. They call it investment. It's bookkeeping with fiber optic cable. And it goes one layer deeper. In Q1 2026, more than half of Amazon's quarterly profit came from the revaluation of its Anthropic stake. Not from selling products, not from real cash flow, from updating the estimated value of a private company that has never turned a profit. Alphabet did the same with its OpenAI stake, $28.7 billion of a $62.6 billion quarterly profit from revaluations. No cash changes hands. But the balance sheet looks spectacular. This is how it works. Amazon's Anthropic stake goes up in value. Amazon books a profit. Amazon's stock rises, which makes Anthropic's valuation seem justified, right arrow, which makes the stake worth even more. The loop feeds itself until it doesn't. This isn't capitalism. It's accounting at industrial scale. Friedrich Hayek won the Nobel Prize in 1974, in part for his analysis of exactly this dynamic. Hayek's core point: a boom is not automatically good. A boom built on distorted price signals constructs a capital structure that is fundamentally unsustainable. Here's the number that exposes the gap. The AI industry needs approximately $2 trillion in annual revenue by 2030 to justify current investment levels. Today, total enterprise AI spending globally was around $37 billion in 2025. The distance between what is being invested and what the market is actually paying for today is not a gap, it's a chasm. Hayek would have asked, where does the assumption come from that this demand will materialize? His answer: it doesn't come from real customer needs expressing themselves through the price mechanism. It comes from the expectation that cheap capital keeps flowing, that valuations keep rising, and that someone, eventually, will show up with real money. And that expectation was itself made possible by 13 years of near-zero interest rates. The boom isn't a market signal. It's an echo of monetary policy. Honesty is an Austrian principle. So let's take the counter-argument seriously, because the bulls aren't wrong about everything. Nearly 3 out of 4 companies worldwide say they are already seeing measurable ROI from generative AI. Research shows AI triples productivity on approximately 1/3 of tasks, particularly in drafting, research, data analysis, and coding. These aren't press releases. These are operational results from real businesses. Cloud revenues are growing at rates that are genuinely hard to dismiss. AWS up 28%, Google Cloud up 63%, Azure up 40% in Q1 2026. 79% of executives report seeing productivity gains. The operational value exists. And some AI companies look structurally different from the others. Anthropic's burn rate is falling. Enterprise customers are stickier than consumer subscriptions. Claude Code alone generates $2.5 billion in annualized revenue. Anthropic's burn rate is projected to drop to roughly 33% of revenue in 2026 and just 9% by 2027. compared to OpenAI's 57% burn rate holding steady through 2027. So AI is not the dot-com ghost town of 2001. The technology works. Some of the companies are on a credible path. The Austrian question is therefore not, is AI worthless? The question is more precise than that. Does the scale of investment match the scale of real demand? And here the data gets uncomfortable. Goldman Sachs chief economist John Hatzius stated bluntly that AI contributed basically zero to US GDP growth in 2025. His words, "We don't actually view AI investment as strongly growth positive. We think there's been a lot of misreporting of the impact that AI investment had on GDP growth." The reason matters. When companies buy AI chips and servers, the value added shows up in Taiwan's and South Korea's GDP, not America's. The core semiconductor value chain lies outside the US, creating a gap between the perception of a domestic AI boom and what actually registers in national income statistics. Hundreds of billions invested. GDP impact, basically zero. Only about 25% of AI initiatives deliver expected ROI. Only 16% have scaled enterprise-wide. Now the number that ties it all together. JP Morgan calculated that to drive a mere 10% return on modeled AI investments through 2030, the industry needs $650 billion in annual revenue, in perpetuity. Their words, an astonishingly large number. Let's put that in context. It is the equivalent of collecting $34.72 per month from every single iPhone user on Earth, forever. Or $180 per month from every Netflix subscriber, permanently. The actual industry-wide AI revenue today, roughly $25 billion. The gap between what's needed and what exists, 26 times. JP Morgan's own biggest fear is a repeat of the telecom and fiber build-out, where the revenue curve failed to materialize at a pace that justified continued investment. This is exactly what Mises described. Not fraud, not conspiracy, just a capital structure built on expectations that were themselves made possible by a decade of artificially cheap money, and which now need to deliver returns in a world where money actually costs something again. Only a few companies are realizing extraordinary value from AI today. Many others experience modest outcomes, some efficiency gains, some capacity growth, general but unmeasurable productivity boosts, results that can pay for themselves, but that don't add up to transformation. Pay for themselves is not a $4 trillion valuation. Some efficiency gains is not $650 billion in annual revenue. That gap between what AI is delivering today and what the capital structure requires it to deliver is not a technology problem. It's a price signal problem. And Mises had a name for capital structures built on false price signals. He called it malinvestment. The Austrian school is not a doomsday theory. It is a theory about structures. And what happens when structures built on false signals meet reality? The structure here is clear. The 5 largest hyperscalers raised $108 billion in debt in 2025 alone, more than 3 times their 9-year average. Analysts project $1.5 trillion in debt issuance over the coming years to fund planned AI build-out. AI assets depreciate at roughly 20% per year. The planned $2 trillion in AI assets by 2030 means $400 billion in annual depreciation, more than the combined profits of all hyperscalers in 2025. The model only works if revenue grows fast enough. Mises would say, there are 2 possible outcomes. Either the real market grows fast enough to justify the capital structure. In that case, this wasn't malinvestment. It was high risk but correctly allocated capital. And the entrepreneurs who bet on it were right. Or the market doesn't grow fast enough. Then comes the correction. Not as a catastrophe nobody could have seen coming, but as the logical consequence of false price signals compounding over 13 years of near-zero rates. In either case, the core principle of the Austrian school holds: the market finds the truth. Always. The only question is when, and how painful the path there will be. The next 3 years will reveal which AI investments represent genuine wealth creation, and which ones were, as Botter would have said, bookkeeping with fiber optic cable. Mises knew this in 1949. He wrote it in Human Action. We just never listened. That's it for today. The money goes in circles. Now you know. See you next time.